The countdown has officially begun. We are now just hours away from the expiration of geopolitical pause. And while the world holds its breath for tomorrow's Friday deadline, the financial markets are already flashing a terrifying warning sign. Crude oil has anticipated the breakdown of peace talks, aggressively surging back up to $94 a barrel. The energy sector is pricing in immediate escalation. Yet, if you look at the precious metals market, there is a bizarre, suffocating silence. Safe haven assets are being completely suppressed. Gold is artificially pinned down at $4,400, and silver has been violently hammered down to exactly $67. This is not a natural market consolidation. This is a highly calculated, engineered calm before an absolute macroeconomic hurricane. Wall Street knows exactly what happens when the markets open after tomorrow's deadline expires. Which brings us to the most critical question every physical stacker must face heading into this weekend. Is the banking syndicate planning to use this massive geopolitical tension to execute one final devastating paper smash? Are they preparing to crash silver even further, driving it all the way down to $55 before the weekend is over? The mainstream media will tell you the metals market is just reacting to the strong dollar. That is a smokescreen. We are witnessing a desperate, coordinated operation by institutional short sellers who are running out of time. They are intentionally bleeding the paper price today, hoping to trigger massive retail panic by tomorrow's close. They want you to look at your portfolio, see the $67 price tag, and surrender your physical ounces out of pure fear. But if you zoom out and look at the technical charts, this artificial suppression starts to make perfect, terrifying sense. The $55 target is not random. It is a highly specific, mathematically calculated trap door. Let me show you exactly what the technical data reveals about Wall Street's ultimate weekend master plan. Before we expose the exact mechanics of this weekend trap, I want you to drop a comment below and tell me, are you holding your physical stack in fear, or are you preparing cash for the ultimate $55 dip? Lock your answers in right now. Let the algorithm know who the real unshakable stackers are in this community. Now look at the technical data. Master chart specialist Gareth Soloway has been warning about this exact scenario for weeks. He has consistently pointed to a catastrophic technical flushout, projecting gold dropping toward $3,500 and a brutal, unyielding breakdown sending silver all the way to $55. But this isn't a natural technical breakdown driven by free market forces. This is a heavily managed, deliberate demolition by the major bullion banks. For months, these mega banks have been suffocating under massive bleeding short positions in the silver market. They know that once Friday's geopolitical deadline passes and the war premium returns, oil will skyrocket. And if silver breaks out while they are still holding those short positions, it will trigger an institutional extinction level event. So what is their master plan? They must drive the paper price down to $55 at all costs. At that specific psychological level, they expect retail investors to completely capitulate, triggering millions in stop-loss orders. The banks will use your manufactured panic to quietly buy back and close their short positions in the green. But there is a massive glitch in their matrix, a glaring disconnect between paper illusions and physical reality. Because if you look at major online physical retailers like SD Bullion today, the demand hasn't dropped a single percentage point. The paper price says 67, but physical buyers are aggressively clearing out the shelves. Wall Street wants to get to 55, but they are about to collide with a terrifying industrial reality. Wall Street is trying to force paper silver down to $55, but they are ignoring the unbreakable laws of physics and mathematics. The physical cost of production for primary silver miners has absolutely skyrocketed thanks to surging energy and oil costs. At $55 an ounce, the entire global mining supply chain becomes mathematically insolvent. Miners will simply shut off the machines, withhold their physical inventory, and refuse to sell at a manufactured loss. This creates an instantaneous, catastrophic physical choke point right as global industrial demand is exploding. Tech giants and defense contractors are not trading paper derivatives. They are consuming real physical silver at a record pace. The massive expansion of solar panels and electric vehicles requires tens of millions of physical ounces that simply do not exist at $55. Their demand is entirely price inelastic. They cannot substitute silver without destroying the efficiency of their technology. So when the bullion banks artificially smash the paper price down, they are compressing the silver market into a tightly coiled spring. The $55 level is the absolute maximum mathematical limit of that compression. It is the rubber band effect in its purest form. The harder they push it down, the more violent the eventual snapback will be. When this manufactured $55 illusion breaks, silver will not just recover. It will completely overshoot. The massive short-covering panic by the banks themselves will act as rocket fuel, launching the physical price to uncharted territory. The mega banks know this. They are just trying to survive tomorrow's Friday deadline and close their shorts in the green. But they have made a fatal miscalculation. While they play psychological games with Western retail investors, they have left the back door of the vault wide open for the true apex predators of the global economy. The Eastern superpowers are not panicking over this $55 crash. They have been patiently waiting for it, and what they are about to do this weekend will permanently break the COMEX. While Wall Street plays these dangerous paper games to cover their shorts, Beijing is quietly executing a masterclass in arbitrage. China is the undisputed global hub for electric vehicles and solar panel manufacturing. To dominate the technological future, they require thousands of tons of physical silver as a core raw material. They have been patiently waiting for the bullion banks to crash the paper price down to this $55 trap. For China, a $55 spot price is not a crash. It is the greatest raw material discount of the century. The moment the paper market hits that psychological floor, Eastern mega investors will unleash heavy, relentless buying. They will buy billions in paper contracts at the rigged Western discount and immediately demand physical delivery in Shanghai. We are about to witness a ruthless, coordinated drain of the COMEX and LBMA vaults. Massive cargo ships are already lining up to move millions of ounces of physical metal permanently to the east. The Western banks think they are shaking out weak retail hands, but they are actually handing over their physical reserves to a superpower. By the time the weekend is over, the physical inventory required to settle these paper shorts will be mathematically gone. Wall Street will be trapped in a nightmare of their own creation. The rubber band is stretched to the absolute breaking point. They will be forced to declare emergency protocols, halting all physical withdrawals as the shortage goes completely mainstream, and when the industrial giants realize the vaults are empty, the panic buying will be exponential. The price of physical silver on the black market and Eastern exchanges will violently decouple from the rigged U.S. ticker. The wealth transfer from the impatient retail stacker to the informed global elite will be irreversibly complete. This $55 deadline is not a reason to panic. It is a siren warning you to prepare for the inevitable snapback. The only question left is, will you be holding the line when the physical squeeze detonates this weekend? If Wall Street successfully smashes silver down to $55 this weekend, do not let panic cloud your judgment. Selling your physical stack at that level is exactly what the elites are praying for. Instead, understand that $55 will be the absolute greatest physical buying opportunity of this entire market cycle. While the algorithms print fake paper contracts to scare the masses, you need to do exactly what the Eastern superpowers are doing. When that $55 trapdoor opens, run to major trusted dealers like APMEX or JM Bullion and secure every single physical ounce you can before their inventories are completely wiped out. Because once the industrial panic sets in and the physical shortage becomes undeniable headline news, this rubber band will violently snap, leaving the paper short sellers trapped in a historic wipeout. So I am asking you directly, are you going to be a victim of this weekend's engineered crash, or are you backing up the truck? Drop your exact game plan in the comments below. Let the algorithms know that this community is stacking, not selling. Hit that subscribe button and turn on the bell notification so you do not miss our emergency weekend updates. The $55 trap is set. Stay sharp, hold your physical, and I will see you in the comments right now.